Hey YouTube, this is one of the top 6 reasons why I invest in real estate. Number 1, cash flow. Number 2, appreciation. Number 3, equity. Number 4, tax benefit. Number 5, leverage. And number 6, passive income. We'll go in depth into what each of these different topics really mean. So starting with number 1, cash flow. Cash flow is really the difference between gross income and expense. Any amount left over is called cash flow. You're generating a positive cash flow if the difference is positive. Conversely, you're generating a negative cash flow if the difference is a negative. Appreciation is the increased value or worth of your property. How much of this increase is based on several factors such as your local market and the improvement to your home. For example, you pay a $100,000 home today, and in 5 years, it's worth $200,000. Your home just appreciated 100% in those 5 years. Number 3, equity. The difference between the market of your home and the amount you owe to the lender on the mortgage. So, for example, you finance your property for $100,000, and in 5 years, it's worth $200,000. Then you would have gained $100,000 in equity. There are several ways to use the equity in your property, but we'll discuss this in a different topic. Moving on to number 5, we have tax benefits. As an investor, you get to write off certain deductions for tax purposes. For example, expenses are tax deductible. The IRS defines expenses as ordinary and necessary expenses for managing, conserving, and maintaining your rental property. For example, maintenance, insurance, taxes, and mortgage insurance are all examples of expenses. From a tax perspective, this means qualifying expenses are a dollar-for-dollar deduction against your gross income, thus reducing your overall tax liability. One caveat is if you make improvements to your property, such as buying a new furnace, water boiler, putting new windows in your property, or making major improvements to your property. These costs are capitalized instead of being expensed. This means the total cost of your improvement follows a complex calculation to determine how much you can deduct each year as defined by the IRS. This means you get to deduct a lesser expense amount against your gross income. But hey, it's still a benefit to you, so take it. Down payment. You're essentially using $3,500 of your cash, and the bank is financing the difference, which is $96,500. Of course, this is an oversimplified example because we're excluding other costs such as closing costs, inspections, etc. But this example drives home that you can use the bank's money for pennies on the dollar. And the last reason why I invest in real estate is because of the passive income. This is the idea that you can make money without trading your time for a dollar. For example, going to a 9-to-5 job, working set-up hours for a wage. In real estate, if done correctly, you can generate passive income even when you are sleeping, talking on the phone, walking your dog, and by watching this YouTube video. If you like this video, give me a thumbs up in the link below. Share and subscribe. Until next time, stay humble, stay hungry, and keep on grinding.